Hello, my name is Mina Yang, and I'm with Wagner, Kirkman, Blaine, Clomperens, and Humans. Today I'm speaking with Charlotte Wall of Spot Lucian Wall and JT Forbes of Bogdan and Fresco about how the Tax Cut and Job Act is impacting what we do as CPAs and tax practitioners, and how the new legislation is affecting our clients. Charlotte and JT, do you have an opinion on what you think the most significant change or new provision is with our new tax bill?
I think, the interesting thing about the new tax bill is that it hits everything. And so I think it depends on what kind of clients that you have, what you're working on is what's the most impactful. So at our firm, we do a significant amount of international tax. And so clearly, the 951A, which is the global intangible low tax income, included in gross income, blah, blah, blah. And it's better known in our circles as guilty. And that has been a big shakeup, right? Because it makes us re-evaluate all the structures that are in place. And so we basically had to look at most, if not all of our clients on how that income was going to flow, how business should be structured now with the new tax bill. And JT, I don't know about you, what was the most impactful about yours?
I think it's about the same. I mean, I know what is the most impactful, and I know what the clients feel is the most impactful. They're two different things. For us, it was the 965 income, the repatriation of for the income tax purposes. That's having a large impact on a small percentage of our clients, but you're right, it made us go back and look at our clientele and look back at their structures and how things are formed to be able to decipher exactly what needs to be included in income for this year. And so that was rather complex, and it's having a big impact money-wise, billing time-wise, et cetera. So, clients care more about the state tax deduction than they do about 965. But Until now.
Okay.
And you have to be able to explain 965, and it's tough to do when the bill's dropped in December and tax season hits, February through March for a lot of these corporations. It's a difficult job to kind of decipher everything and to go back and look at all these structures like you mentioned. It melted my brain.
Right.
Yeah.
And really, I mean, the way I tried to do it, I didn't get into the technical discussions because I had a couple of people that were really going through and doing all the calculations. And I basically said, it's as if we're going to accelerate all of your deferred income up to this date. And I think the biggest surprise to some people that don't do it a lot is that it wasn't coming into place in 2018. This was 17.
Correct,
So when they signed that bill, I mean, we were racing, and we were racing even before then, right? That because it came into play, as early as January 2017.
Right. I think in this tax bill, it's unique in the fact that a couple of these things were retroactive, this being one, depreciation being another, but this one being the most impactful for us. So you had to deal with it during tax season to try and figure out how much to pay by April 15th, and whether you could defer it, or take it over payments, et cetera. All these questions had to be answered, and I'm not sure that we had the legislation to deal with all of that at the time. So we did the best we could.
Well, at least now they're starting to put out some regulations and some guidance.
Right.
So it seems like every couple of weeks we're getting some more guidance on some of these things, and so that's been really helpful. But it's a lot. It's a lot to take in, and I guess that's why there's so much work for CPAs and tax attorneys these days, right?
Why the government targeted this one, right? Because it was kind of a subtle thing that was sort of
That's right.
back there that
right.
people weren't paying attention to until now.
Right. There's so much in this tax bill that, there's the average taxpayer that understands the 3 or 4 things that's marketed to them about the state tax deduction and mortgage interest. But we as professionals know there was a whole back end that just got more complicated. So as I mentioned to you earlier, the tax law is not complicated because state taxes are deductible or because mortgage interest is deductible. They're complicated because of all the foreign reporting that has to be done now, the changing in the foreign landscape. It's bleeding into everything at this point. And so if we're having difficulty with it as professionals, imagine the average person, the average taxpayer, what they're having to deal with all that and what the compliance rate is with them. So,
Well, I think that the other thing is that the thing that is on everybody's mind, especially in California, is the state tax, the real estate tax, right?
Right.
What are we going to do? It's only, 10,000. And, even me, who does this all the time, right? The first thing I was thinking was like, oh, this is going to be a nightmare. And then, of course, logic sets in. And you sit back and say, oh, well, a lot of the clients didn't get that anyway. So
That's right.
Maybe it doesn't matter, right?
Well, I think
And-
that's interesting, right? I
Right?
think in the media there was a lot of attention given to this is being taken away, this is being deleted from the codes, this is being deleted. But once you take a look at the clients that you're working for, it's already gone, right?
Right.
And I go, you sit there to have a conversation with your client, and he goes, okay, my goodness, this happened. And I go, well, yeah, but you never got any benefit out of it anyway. And they're like, oh, okay. So there's a lot of education process, I think, that has to happen, as well as to kind of temper things in terms of what the media did, since it was such a visible.
Right. I mean, a lot of my
change.
clients were calling me about the state tax deduction. How does that affect me? And you're right. If you're a name table, it doesn't affect you. It never did. And so, in many cases, I'm sure, as Charlotte's done, you do, tax projections to find out the implications of the new tax law. And we're finding in some cases that people come out better than expected. And, there will be the extreme cases where they're going to come out worse. But, with AMT changes, with the exemption amount and being able to use it a lot more than you used to be able to, it's more beneficial. And that's kind of the surprise that I had with this new tax bill. I read into the hype and everything else too, and I was worried about state tax deductions. And then you actually, as we always tell everybody, well, I got to put numbers to it to be able to find out the real answer. And so started putting numbers to it and didn't find that. So, so a lot of them are actually kind of happy about the tax law changes in some regards. So
I'm interested to see in the next couple of months what comes out of the states changing the state law, right? Of can they change the law a little bit differently so that it's still a deduction, right? And there was all of this knowledge in
What
the
is a tax
newspapers.
versus
What is
a
the tax?
fee?
What is the
And- yeah.
fee? And all of that. And actually, one of the reasons I like to go to conferences and stuff when we talk about these things is that we can really hear about what's going on in our legislation. And I think that there was a state, I think it's Connecticut, but I'm not sure, that I heard about through commutative taxation, that were talking about that it had passed and they thought it was going to pass muster, and so some of the other states are going to change that too. So that's going to change our calculations as well, is if we can start taking it as a charity. Is that what they said?
I'd be surprised if
Something like that, a
California
donation.
allows it though,
Definitely
right?
Donation.
some creative ideas out there.
Right.
And there is going to have to be some collaboration, I think, and understanding between the states and the federal government. I'm not sure that does quite work or not work.
I
We'll
don't
see.
think it.
Yeah.
I don't think it works the
Yeah.
way when I heard it.
Yes.
Early on,
Uh-huh.
and so they've tweaked it some. And I tend to be one of the skeptical people when I look at it. That doesn't feel necessarily comfortable.
Right.
But like I said, there's one of the states on the East Coast has passed it, so we'll see.
Interesting.
We'll
So
see.
now, what about the big change in the C corporation tax structure? What do you guys think about? Because that's a big deal, right? 21%. I mean, and it definitely, it has a trickle down. I mean, for the most part, those of us that have represented the entrepreneurial client, C corporations are almost taboo, right? So
Right.
we're recommending pass-through entities, partnerships, and S corporations, and now you kind of have to rethink that model
Right.
a little bit depending on the circumstances. And then the difficulty that I see in our practice, which I'm sure is the same, your clients are always asking you to look into the future and how long
Right.
will we have this tax structure, which nobody has any idea, but 21 as compared to 39, depending on the circumstances, is a really big deal. So, how are you guys seeing or addressing any of that yet?
Well, I'm getting a lot of phone calls about people that are individuals are considering whether they should incorporate. I think this leads into the 199A discussion about the qualified business income deduction. But, a lot of people are trying to understand it, and they're trying to understand it before I could. Again, this is during tax season. And so a lot of them want to know if they should change entities right away. And so it was hard for me to answer that because I didn't know, because I didn't play it out yet. I didn't have time to do that. But, in some cases, it makes sense not to change anything. You may still get this deduction and get something close to the 21% tax rate at the C Corp level. But I think you're right, we're going to see a lot of C Corps pop up again, whereas before we saw a lot of them die down.
Right.
And it was just all LLCs and S Corps for the favorable tax rates. That's the whole point
Right,
of
right.
everything. And so now the C Corp has a favorable tax rate,
Right.
right? And it's probably a little bit easier to deal with from a tax perspective.
Right.
So I think we're going to see a resurgence of that to some extent, but I don't know.
I think the interplay, the thing that I think is so difficult is that the volume of interplay between the new deduction under 199A and, the flow-throughs that would qualify for, or having the S Corp, or having the C Corp with the lower tax rate. You have to go back and forth, and you have to say, well, do you qualify for this, and how does that look? And so, you're right, the projections are, I don't want to say a nightmare, but they're a lot of hours, and so they're expensive too, right? As far
Right.
as, and I think sometimes our clients think that we're like super great and that we just have this stuff off the top of our head, right?
Right.
And it's not. You have to really kind of really crunch through the numbers and crunch through the
Right.
business to see what they qualify for, what they don't qualify for.
Right, so that's, particularly in the real estate industry, the structure there for real estate is often that you use separate pass-through entities for each particular real
Right.
estate project, right? So you could have a client with 10, 20, 100 separate different entities, and what that 199A does or doesn't mean to them, you have to look at all of those, and your client doesn't quite understand that.
right.
And, that part of the reason you set up all those different companies is so that they would be, in some circumstances, treated as separate entities. And 199 is a whole aggregation kind of concept, right? Bringing it all together and treating it as a trade or business. So that's kind of hard for your clients to understand. And then, as we all know, the rules and the regulations haven't quite caught up with all of it, some of it, but not
Right.
all of it, right? And so actually that's one of the topics at the conference is the 199 and where it came from and where we see it right now and where we're hoping it will be interpreted to be, right? Because I think the whole idea is that was supposed to be the bridge between the pass-through tax rates and the C corporation tax rates. But I think, that's rather confusing to the clients, that all they saw is that the big corporations were getting some
Right.
wonderful benefit, right?
And Mina, those regulations came out in August.
Yep.
So I'm sure you've read them and you're an expert on them at this point.
Oh, nice.
Like, hoping to be an expert by the
As your clients
by the
expect.
time the conference comes around, yes.
As your clients expect that you
Yeah,
would be.
that's right.
But I think even those proposed regs coming out, they're still unclear
They did
on
not,
many
they
things.
didn't address
They
all the
didn't-
issues
right.
that we had hoped, that's true. So there is definitely still ambiguity.
Right, and you're going to be talking about those type of things at the conference?
Yes, we will be.
Okay.
Uh-huh.
Because the
All
big question,
the
does it
works
apply?
and the confusion, right? But, and so there isn't going to be complete clarity, but there has to be, it depends on the risk tolerance of the client. But at the same time, you'd have to go back to the spirit of what the intention of the whole
Yeah.
code section was.
Right.
It was to bridge that gap, right?
Right.
Right. Well, and I think it is limited based on, the ultimate taxpayer. and, you know, what their tax rates are too, right? So, you know, there are some limitations that are somewhat disappointing, I think, that, you know, reduce the, you know, the real benefit of that new deduction.
Right. And I mean, you know, again, I do, as you can tell, I do a lot of work in the real estate industry. It's a hard press because a lot of them use subcontractors, you know, is their quote, labor component,
Right.
and that isn't a wage. So,
Right.
you know, because 199 is all about wages, yeah.
Right, will this be a big push to make those people employees at that point?
Well, we'll see, but
I mean,
that's a whole change in that industry, right?
Right, that
Yeah.
those
I
people
mean,
may
that-
not accept,
Yeah.
right.
I mean, there are reasons why
Yeah.
certain types of real estate companies don't want to have that big workforce,
Right.
right? Subcontracting is the more advanced.
Well, and those
advantageous way to
subcontractors
go.
want to capture that deduction on their personal returns
Correct.
themselves. So they can't do that if they're going to be an employee.
Well, that's one thing that's clear under 199A, right? Is you can't do it twice. That
Right.
That part's clear.
Yeah. They always make that part clear.
So,
No
and-
double dipping.
Yeah. So, but, and so is in regard to these sections or any of the other sections, are you seeing a direct impact on the way your clients are working or interacting with you at this point in time?
From my perspective, not really. I think that everybody's a little bit more aware of it, but I think it hasn't accelerated or decelerated what a lot of people are doing. I think that they are all looking around, thinking about, do we need to restructure? But those are the conversations that we started, you know, even last year, going into seeing what this bill looked like. That hey, we need to start looking at this stuff and thinking about it. But trying to go through it methodically, as opposed to, like you say, you know, some people wanting to jump in and just make a switch in businesses right away without kind of stepping back and seeing what the real impact is.
I mean, I think as we get more information about the deduction and how it all functions, then we'll start looking at that tax planning. But I think right now we're kind of sitting back. You know, if there's an obvious change and it looks like, yes, this obviously looks like it's something that is for you, you should change to an S Corp right now, et cetera. Like, we recommend that for sure. But, you know, there's still a lot of ambiguity. I don't know. And so, you know, we're just trying to wait to find out what more information comes out, wait for something like this conference to see what the ideas are coming out of that, because, you know, it's all about tax planning at this point, and it's getting harder to tax plan, especially with everything that's happening. So, you know, state tax deduction used to be a big tax planning item for us. You know, if you were in an AMT, it was a big trigger to save a bunch of federal tax. It's gone. And so I do a lot of employee stock option work, and so we do these projections about them selling their stock, you know, before the end of the year, and whether they should prepay their California taxes. It was a huge tax savings, but now that's gone. So looking for other avenues, not to say that this is, you know, they should form a corporation to do anything, but, you know, a lot of them will. They'll go into forming corporations with the money that they've earned, and they'll want all these answers because it's all out in, you know, in the public now. So they're expecting answers from us at this point.
Well, I think it's kind of interesting that, you know, when the tax cliff happened, I got tons and tons and tons of calls, and I was very tired that December, I recall. But there are fewer calls with, even though this is a bigger change, there are fewer calls, and I sometimes feel like maybe both the practitioners and the clients, it seems almost a little bit surreal, right?
Right.
Because what parts of it are going to stick and stay. Because, you know, we're definitely capable of helping our clients plan through these changes if they're permanent. But if they're not, what does that mean to everyone? And particularly with this new C corporation tax rate, what I try and tell my clients is, yes, it definitely helps on the earning of the money, the corporation's earning the money, but it doesn't change you having to get the money out of your corporation.
Right.
That's so it looks nice in one particular way, but for the clientele that is been using the S corporation and the partnership structure, you still would have to get the money out, and that generally is a taxable transaction. which maybe a Google or whatnot is not so concerned about getting it out to a particular person on a
Right.
tax-free basis. So that's I think part of the education process that people have to understand. Right? The conference will be held November 15th and 16th at the Sheraton Universal Hotel in Universal City, just outside of Los Angeles. If you have yet to register, please do so today. I hope to see you there.